so.
We have, I just came to support everybody else.
We'll be.
You like refreshers.
And you've been here before, right?
I think I had a class with you in Gainesville
Okay,
a long time ago.
that's right.
And this is Lamont and Kim are gonna be joining us down in Lorton, so.
Sweet, okay. All right, well, cool. Well, we're gonna do a Veterans Affairs home loan overview. Talk about really what we're trying to do is break down some of the aspects that you can kind of take when you're talking to people. To show you the great things about the program and also just things that will, kind of open up some doors to home ownership. Sometimes when the veterans don't know they have it, and just mostly about maximizing their benefit is what this is about. So I need to click through. The first thing is, I wrote this slide a long time ago. This is not just with VA loans. What happens, what we hear a lot is how long VA loans take. So if you're a listing agent or you're representing a buyer, that's a little bit of a misnomer. We're still doing them in 30 days, sometimes even shorter. We like to have 30 days because the appraisal can take a few weeks to come back. So I usually just tell people 30 days, and sometimes they do 28 or something like that. But a lot of veterans are hearing and agents are hearing that sometimes it can be 45, 55, 60 days. And that's not the case. That may be the case at some particular lender, but that's not always the case. And we don't want in a competitive situation with our low inventory that we have now in Northern Virginia, and kind of the DC market in general. We don't want our veterans to be handcuffed by that belief, which makes their offers less competitive. So that is not the case at all. That is not the case at all. The credit unions have, I think, I would say in the last 5 years, a lot of them have kind of opened up real estate companies. So I will tell you, most of your veteran clients are going to bank at the credit unions. They're great banks. They have accounts there, but they're pitching them their real estate services too. Okay, so you need to be aware of that because they want your real estate business too. They don't want to just do their VA loan for them. Okay, so veterans, yes.
Sorry, do they have agents that are tied in with them, or they just refer?
Yeah, it's not every credit union. It's a couple of the bigger ones that I can think of locally have agents. One of them has a lot of agents. One of them has more of a referral-based program where they may even be tying into you and we're looking for to split a commission or something like that.
You.
What's that?
Do you have agents?
No, that's why I explained
Where
it.
is
Referrals.
agents?
We only want the loan business. We're not trying
But an
we're
example
not
of
trying
that
to
is
sell them a
like
house.
USAA, if you go to there, they've got the USA Movers Advantage program, and then they don't, the VA.
You got, and I'm not here to talk about the exact credit unions because I compete with them, and I think it's bad form. They're good banks, and I think they mean well for the customers. But I'm just telling you, they want your customer real estate business too. So, I think in general they can tend to get a little bit better service and sometimes even better terms elsewhere. So, might as well help them go elsewhere if they're going to take your real estate business or try to take your real estate business. Okay. All right. The Veterans Affairs Home Loan is a residential mortgage loan for eligible veterans. Okay. Just to buy or refinance an existing home loan they already have. Okay. You hear this thing about VA guarantee. And what that means is veterans loans are guaranteed to the lender against default. It doesn't mean you're guaranteed as an eligible veteran to get a loan. You still have to qualify, have decent enough credit, be able to document your ability to repay the loan and meet VA's guidelines. So a lot of times veterans think they're guaranteed to get a loan because they've earned the entitlement. Those are two different things. It is a flexible program, but it's really the lender that's guaranteed. That's if a veteran does not pay back the loan. It usually causes substantial loss for the bank or the lender. There's kind of an insurance policy written by the federal government. That's what the VA guarantee means. Okay? Because it is the federal government insuring the loan, which is not what they call it. They call it guaranteeing, but it's essentially like the government's an insurer behind the loan. We're able to make the loans at very friendly terms, no down payment, extremely good rates. Okay, so the government is backing it. The government's not paying for it. Taxpayers are not paying for it. That's another confusing thing. It's a self-funded program by veterans. Okay, through Veterans Affairs. Okay, that insurance policy is. It's not exact, but it's essentially worth 25% of what the lender lends. So if someone owes $100 grand, buys a house for $100,000, finances $100,000, and they default, it's kind of more like we're making a $75,000 loan. Okay, which would be what we call a 75% loan to value. If we're loaning less money relative to the collateral of the house value, it makes it so the lender can get better terms, not have mortgage insurance, things like that. So that's what you have there. Okay, why does this benefit the veteran? The veterans pay a premium, which they finance. It's called a funding fee, which we'll break down. Okay, and by doing so, it gives them access to market rates. I would say even below conventional market rates, without having to put down a large down payment or any down payment at all. Most of the veterans loans we write are no money down, but we'll talk about the down payments as well. Okay, so the program is basically designed to facilitate home ownership and be a benefit for the military servicemen and women, and that's active and previously active. Okay. Okay. We talked about it a little bit. It is 100% financing up to a certain extent. In our area, they can finance 625.5 with no money down. And we're going to drill down on that because that's really important for you guys later when you're helping people.
How much was it, 625?
Our county limits around here, all the counties around DC, are $625 and $500. Don't ask me why they do the $500. It's weird.
And
Okay, 625 grand.
is that with the funding fee or without?
That is without.
Okay, can you add that on top?
Yep. The credit score requirements are quite flexible. The program is designed to give the veterans the benefit of the doubt. It's not a real credit score driven program, meaning conventional loans, you get different rates when you have a 660 versus 680 versus 720. It's done in increments of 20 points, and it's really technical on conventional loans. That's not the case with VA. You pretty much should have access to the same rate. You got to be really low on the credit scale too, and even so, they're just paying slightly more. Okay, versus a conventional loan, if you had a 740 score versus a 640 score, you'd probably pay at least a point more or 1% more in rate. You may pay an eighth more with a conventional, with a VA loan. So it's really beneficial for the people who have it. Okay, so it's very flexible in that regard. Lower no money down. We talked about sellers can cover the closing costs, and we're going to drill down on the things that are going to be important for your job. But here are just some of the biggest benefits. No mortgage insurance. That's a big key, and that's what makes it cheaper than a lot of other programs if you compare it to FHA or a conventional loan with mortgage insurance. Or a conventional loan without mortgage insurance, because a conventional loan without mortgage insurance, with less than 20% down, has some kind of form of a higher rate or extra closing cost to buy out of the insurance. VA doesn't have that. So it's sweet. Okay, so the rates are better. We've been writing VA loans, 400, just to give you an example, the last couple months at 3 flat, 3 1/4, stuff like that, whereas the conventional rates have been, the lowest I've seen them is maybe 3 1/4 and more in the mid threes. So I've seen as much as a 0.5% difference between the rates lately. Okay. Cheaper than renting in many cases. There's not a lot of no money down or very low money down programs where if you look at it side by side, it's just flat out a lower payment than renting. Okay, it may be better long term for the homeowner, or especially when you factor in tax breaks and stuff like that. But a lot of times with VA, because it doesn't have mortgage insurance and the rates are so low, you can just put it side by side with rent, and sometimes it's just flat out cheaper or the same. Then you put in tax break on top of that, and you're really cooking with gas at that point. So it's really the only program I can think of without a big down payment that has a comparable cash flow to rent. 30-year fix, there's no prepayment penalty. You can get adjustable rate VA loans. You can also have, we're going to drill down on this too, you can have multiple VA loans at the same time, which is a misnomer, okay? Or misunderstood by agents, borrowers, lenders, misunderstood across the board.
Do they have to all be primary residents, or can they be, investment vacation properties?
They have to be, that's a good question, they have to be a primary residence when you're getting a loan. So if you left the house and turned it into a rental, that's fine. But if you're buying it, you're supposed to intend to occupy it for a year. You're going to find that in the fine print with any loan. any conventional loan, FHA loan, VA loan that we do, if it's a primary residence, in the fine print it says you intend to occupy for a year. So, and that's definitely the case with veterans loan. There's not a veterans loan for buying a second home or investment property. It would just be if they keep their current house, let's say they're relocating in the area and they have a VA loan in another place, sometimes they think they cannot use it again, or they're unsure of how much they can use, and we help them with that. Okay. The loans are assumable, and for a long time, I thought you had to be a veteran to assume it. So I assumed that. You don't. We're not seeing a lot of assumptions at all, because rates are so low.
So have to go up.
We have tons of people just in this area that have 3.25 VA loans, things like that. So if rates really spike and you're listing a property, it could be something that's a marketing tool.
How much of a fee is related to that for the new purchase?
Not nearly as much as closing costs to buy a new house, or get a new loan. We don't like it as a lender because we're in the business of making new loans. But there's a processing fee, and now you have to qualify, believe it or not. It used to be,
Yeah,
it was
it was
quite easy to assume. Now you are, as a veteran, leaving your eligibility tied up there. So you have to make a judgment call.
And
I
you're also responsible for the loan,
Now, if another veteran
Default.
comes in and assumes it, they can replace it with their
Okay,
title.
that's the catch.
There's a catch, but, you know, if it's an 8% market and
Yeah,
you
they
can
wanna
work out a
get it.
deal and maybe you know them or someone that's coming in the
When
same
I first
base.
started real estate, we did assumptions.
Yeah, I believe it. I'm sure we'll do them again at some point. Okay, the debt to income ratios are really flexible on VA loans. Not so we can get them extra house, but it's just the benefit of the program is, a big benefit of the program is to give the veterans a benefit of the doubt. And sometimes you have other income in the household. There's a lot of reasons why we may be able to make the loan, we can use more common sense on the veterans loans than conventional loans. Okay, there are a few slides I'm going to skip past because the part of this program, and we're not going to have it today actually, we may. It's an hour-long CE class, so there's a few things that are too long that we're going to skip through. Okay, you can use a loan to buy an existing home, new construction. You can use it to refinance, and you can use it to take cash out. We don't do it a ton in cash out situations. And one of the reasons for that we're going to drill onto is the funding fee is quite high for the borrower. Now, there's a little bit more protection built in for the borrower on the property condition. So for a long time that was a big concern for either the person buying the house or the seller. It's really comparable, if you're familiar, to an FHA appraisal process. We don't look at the home inspection, we're not required to, we don't really want to. But the appraiser is supposed to check that the utilities are working, and they will notate sometimes some safety stuff they may not notate to be fixed before closing, but they may not recommend to be fixed before closing on a conventional appraisal. Okay, that would be things like peeling paint on houses built before '78, locks not working, exposed outlets, things like that that sometimes will slide in a conventional situation. They're required to be fixed. So the appraiser gives us a list of it, we pass it on to you all. We pass it on to the buyer, you all, and the agents involved. Okay? I don't find it to be really cumbersome, but it is a little bit more than conventional stuff. So, wood rot, mold is an issue and everything. Okay, let's talk about the funding fee. If you go in your chart, well, let me actually, the funding fees, this is how the program is funded. This is what your veterans pay when they're buying the house. I'm going to give you some examples here. The funding fees, and I have a chart on the next slide, are anywhere from 1.5 to 1.25 to 3.3% of what they borrow. So an example is, and it depends on how many times they use it, we'll go to that slide. On a $100,000 loan, a first-time user And you don't have to know this when you're writing your contract, by the way, but you're gonna get asked it by your veterans, so it's nice to know a little bit to be dangerous. We'll talk to them about that, and we're gonna finance it. It's not cash they're bringing to closing for the most part, but it's good to know. $100,000 loan for a first-time user, VA charges 2.15% of what they borrow, okay? That will be a first-time user who earned their eligibility through being through being full-time military, not a reservist, okay? So, because it's allowed to be financed, it typically is financed, they can pay it cash at closing like regular closing costs. But for example's sake, and because this is pretty much a real world scenario, in this case it's 2.15%, their final loan amount, instead of being $100,000 on a $100,000 purchase price, with no money down, would be $102,150. Okay?
When you write a contract, on our contract, what are you putting in for like the loan amounts and things?
You're putting in what they're paying for that. You're putting in, so if you're writing a contract, and this isn't realistic, but $100,000 for the house, and you're asking them, what do you want to do for down payment? And they say 0, just write $100,000. You don't need to worry about the funding fee.
Okay.
Okay, because it just doesn't come into play in the contract. Okay, it doesn't affect the seller. It's really just between the lender and the borrower, and you don't need to notate it on there. You just put, and let's say they say, I want to put 10 grand down. You write 90,000.
Okay.
Okay.
So,
And you're basically doing the same thing on an FHA
Yeah,
contract.
okay,
You're not
okay.
writing that upfront mortgage insurance
Okay,
premium
okay.
in there. It would be, maybe people do it, I just haven't seen it. If you've used it before, you're now in VA system as a first-time user. Okay, so now they charge differently. And we'll show you how you can shave that down. But subsequent users with no money down is 3.3%. So this sounds like a big fee, and it is. It's not pocket change at all. But it does, you get that good rate and you don't have the mortgage insurance. So when we look at it over time, it still ends up being a better deal a lot of times than conventional. But 3.3%, that's obviously $3,300 on every 100 grand. Okay, so let's magnify that times our house prices in this area. I don't know what the average is, maybe 450, maybe 500 in Northern Virginia. You know, obviously you're now talking about 15 grand in funding fees. So, the funding fee is generally financed. What's really cool is if you have a service-connected disability, and a lot of people do, and you don't need to be shy about asking, because the second they apply for a loan, that's one of the first things we ask them. Do you have a service-connected disability? And they know, okay, because to get that disability rating, you had to go through kind of a big process with Veterans Affairs. If their service-connected disability is 10% or higher, which a lot of people have, we don't have to collect any funding fees. So even if the funding fee was 20 grand, we collect 0.
wow.
So it's really sweet.
That's really cool.
People that have earned that benefit. And this is another, it's just nice. Okay, these are the charts. This is a little bit of an old chart. As you can see, I need to update this now because I'm sure they published a new one. But they published for a while and they put it through September of 2016. Now what you're going to notice on this chart is when you start to do some down payments, let's say you're a second-time user or you're buying your $10,000, whatever, it doesn't matter. If you start putting down 5 or 10%, your funding fees go way down. Okay, so instead of paying 3.3 if you're a second-time user, you put down 5%, your fee goes all the way down to 1.5 instead of this 3.3 with less than 5% down. So it's about a 60% discount in funding fees. So we're constantly coaching veterans to maybe put a little bit down if they're comfortable doing it. A lot of them don't, but we're at least showing it to them because that's, that could be $8,000 right there on a $500,000 house in fees that they avoid if we just tell them how to avoid it. They either put a little bit of money down, maybe they borrow it short-term from their retirement and then just pay themselves right back when they sell their other house or whatever. So, go ahead, Mike.
When you say a subsequent user, I think maybe somebody asked you that. Is that, let's say, they bought a house with the VA loan, they're selling that, that's going to be paid off, then they're buying another one. Is another one called subsequent, or is another one called they're renting that one out and they're buying another one?
It's just if you've ever used a VA loan before, any other time you use a VA loan, whether you still have it or not,
Okay.
you could have paid it off 20 years ago,
Okay.
you're considered a subsequent user.
Is that something new? Didn't they used to have like the eligibility where you had like a certain amount of money that was devoted to it, and every time you had it outstanding, you used from that pocket of money?
Yes, they still have that, but the
Oh.
funding fee is separated from that.
Okay.
Okay, so we will talk about.
Okay, so the funding fee
Yeah,
is not based on that?
yeah. Now, if it changed, I've been doing it
No.
13 years, so maybe
No,
before
you're
that,
right.
Mike. Yeah, it
You're
could have been. Yeah, I don't know. But I believe this is how. So anyway, the big haircut on the fees, if you put down 5, and then the biggest discount you'd get is 10% down. It goes down to 1 1/4, but that's not nearly the cliff drop. It goes from the 0 to the 5% down. Okay. All right, who's eligible? Sometimes it sounds kind of obvious, but it's not really. And a lot of times, for the most part, what we find is your customers, your clients that you're selling houses to or that you're listing the house with, they know if they're entitled, if they have the entitlement. If they have a question about it, we help them figure it out. We show them how to get their certificate of eligibility, which I'll show you in a minute. They get it, we get it. There's a lot of different ways that it happens. If they're really unsure, a lot of times they don't have the entitlement. That's what I'm finding. We'll check for them, or they can check, but if they're really unsure, more times than not, they don't have it. Okay, active duty personnel, reservists and National Guard members have to spend at least 6 years in the reserves to earn it. Okay, that's one thing we see. They're a little unsure how long they need to be in. Some surviving spouses, if you have someone that's killed in action or dies as a result of something that happened, it's determined by Veterans Affairs. Maybe an injury or an illness or something related to your service. The spouse can kind of inherit that entitlement. Okay, we don't see it a lot, but it's obviously out there. We're going to try to help them determine their eligibility. Like I said, sometimes it's unclear. Sometimes they're just unclear on how to get their certificate of eligibility. And we do it every day, so we'll just help them. Okay? Talking to area loan limits. Okay. What's big for you guys is our county loan limits. Now these switch every year. They don't switch every year. VA looks at it every year and they publish in December what they're going to do with the loan limits. Okay. So they were as high as a couple of years ago. That's an old chart, and I meant to save it through. This is actually a better example. They were as high as a couple of years ago. Let's look at 14. So I just told you what they are now, 625.5. So let's find Loudoun County. Loudoun, just 2 years ago, was 692.5. Well, that was all the way at 847, a year or 2 years before that. So you can see it shifted dramatically. You could go all the way up to almost 850 with no down payment a few years ago. Now they've decided to come more in line with the Fannie and Freddie conforming limits. Okay, so that stuff's big news sometimes. We have people shopping around for houses at the end of those years when they change. So think about this. We know it's going to 625. We have people writing contracts November, December that are banking on the higher loan limits. So just stuff like this we need to pay attention to. We'll circulate it out to you. You got to be.
And when do they make those changes?
I saw, they usually post them in December.
December.
No, I expect them to stay the same this year. Okay? And they could stay the same for a while, but they were dramatically going up and down for a lot of years. I had someone, a realtor call me one time, and they said they've been showing houses to a guy for 4 months or something, and he thought the limit was 7 something, and it was 6 something, and when he found out it was off, he just had to bag the search completely. So it's
Maybe the agent
stuff
got
like,
back too.
they weren't happy. I was,
Gosh.
they should have called me earlier. It took 2 seconds to tell them. So, you know. But anyway, our limits now are 625.5. I went in there today and changed that, and I guess I didn't save it. So let's go back. Okay, now here's what's important for you guys to know. The veteran can borrow more than the county limit, okay? And they're confused about this. If the county limit's 625.5, we do veterans loans over $1 million sometimes. Okay, you have a lot of people in the area that, not necessarily active duty still, unless they're quite high up, general, something like that. But you have a ton of people. Half the loans we do are for retired or separated military. You have a ton of people in the area that work at government contracts or whatever, and for some reason or other they can afford could borrow much more than the limit. Okay, that limit is just for no money down. The way we calculate, when you go above that, now a down payment starts kicking in. Okay, and that's where the confusion comes. But we're gonna do a little example here. What the veteran has to contribute as a down payment, and this will come up when you're writing contracts, and they will actually ask you this, is 25% of the difference, and we'll do an example, between whatever the county loan limit is at the time and what they're buying that house for. Okay, so let's say you're selling a house for $750. And it's a veteran, they tell you, I'm gonna use my VA loan. Okay? The down payment minimum, now they may wanna put down $300,000 for all we know, but let's say they're not, okay? The down payment minimum on that is the difference of that $750 and $625. Okay, so it's $125,000 times 25%, so.
40-something?
Yeah. Now it's $31,250, did I do that right?
Yeah.
25%. It's 31 and change, okay? So that's pretty
Which,
sweet if they can
over
afford it.
over the entire loan, what's that a down payment of?
No, that's like on a $750 house, they can borrow, $719.
But I get,
So it's like a 2%.
Oh, yeah.
What's the down
What's the
payment?
down payment?
Yeah,
divided by
just curious.
750? In that case, it was like 4%, but
Okay,
that doesn't
yeah.
go, you can't use that as a factor. Okay, so it's not like 4% if you buy a house for
No,
nothing.
no, but you can say, hey, you're not getting, you don't have to put down 5 or 10, but you only have to put down 4.
Oh, it's much, it's
Yeah.
much less until you start getting way into the upper echelons of price
But is there a limit to the actual loan, the house price loan thing? before
There's
you-
not, I will tell
Really?
you, I will tell you that our limit, because is 1.5 million. Okay, and then we may have even raised that recently, and I should know that.
I'm not in that price range.
Well, we can do $1.5 million VA loan, so because of the down payment on top of that, now you're talking about having to be in the $2 million-ish price range.
Uh-huh.
So, it doesn't come up a lot. That's why I don't have it memorized. But I know for a fact that we write into 1.5. We do see a fair amount of 1,900,000. I mean, it's not the norm, but it's, if you think about this, if you're buying a house for, say, 1.2, or 1.3, your options are jumbo loan, basically with 20% down and a higher rate, or the VA loan. If I do an amortization and interest calculation for people over time, that VA loan is going to look better even with the funding fee. So when they have that entitlement, and then you throw in the fact that a lot of them have the disability and don't pay the funding fee at all. I mean, if we compare a 3.25 VA loan today to a 3.75, 3.8 jumbo loan or whatever it is, run that over 30 years, that's a huge amount of interest on that side of the loan.
So no funding fee
It's a
if they go
no-brainer.
into that higher price tier,
Not if
if they have a disability.
And even with the funding fee, we'll do the calculation all day long, as long as they have the loan for a year or so, they're gonna save in the interest.
Yeah.
Unless that spread narrows with the rates, but it's not showing any signs of narrowing. Okay? Now, the reason it's that 25%, if you remember what we talked a little bit about earlier, about the government was guaranteeing like 25% of their loan to us as a lender or Bank of America, whoever's doing the loan. So the government guarantee stops at that. What they're saying with their limit is, here's where we stop our guarantee. Now, what happens is, for us to make a loan that works and is saleable in the secondary market, the entire loan has to have that 25% coverage. So basically what we're doing is we're making the buyer put in 25% of the difference, which between that and the government guarantee kind of makes sure the whole thing has 25% coverage
Are they,
for equity.
can they get a second for that, or is that?
For the down payment,
Yeah.
you technically can get
I
second.
mean, are they like generous in that respect too for the veteran?
You can get subordinate financing behind a VA loan. I just don't see it because, like in that 750 example, if they put down, say 30 grand, there's no bank that I know is going to come in and make a $20,000 or $30,000 second to 100% loan versus value. So I know like Fairfax County Credit Union, who we have a partnership with, they'll do they underwrite some second loans for us. It's not an informal partnership. they'll do a loan up to 95% loan to value, but that's where they stop. And that's aggressive, most banks don't want to go that high. And then, by the way, the rate's 6-something% versus just borrowing on a VA loan in the 3s. So it's a good idea, you're smart to think
not
about it, but it's
practical.
not, yeah, it's not practical right now. Okay, property-wise, we have an independent appraiser, just like your other deals do it. It is a VA assigned appraisal. So here's the key difference. On your FHA and conventional stuff, we are using the appraisal management companies that we're normally used to using for 15 years. On a VA appraisal, we actually get the contract, we get the borrower's authorization to get it started, and we upload it into this portal that VA has. They assign an appraiser on their list. Now, because we do so many of them, sometimes I see the same appraiser, but the list is large.
They're not necessarily local then?
I would say for the most part, they're all local. Any appraiser can apply with VA. VA has to, they may have to take some extra licensing or some kind of test that VA makes them do. So the list is large. We don't see the same guy all the time, but we will see some. They're local, they do a good job. We don't see them any different value-wise than conventional stuff. The key difference is those appraisal management companies were a major customer for them. For these individual appraisals that get assigned to Joe Smith, VA appraiser, or Susie Smith, they have a timeline they need to get it back by, and I think it's 10 business days. And I can almost guarantee you every single time it's 10 business days. Well, 10 business days is 2 weeks, okay? So 2 weeks is gonna be your fastest turn time on that. Once in a while, I would say less than 10% of the time we'll get it back a couple days before that. What really confuses the realtors and the listing agents is the appraiser. A lot of times the appraiser, because it's on the route or it works for them, they may go see the property on day 2. Well, everyone thinks, well, you saw the property on day 2, how long can it take to write up the report? Surely the lender should have it on day 4 or 5. No, it doesn't work like that. They're just seeing the property. A lot of what they're doing is back at their desk. Taking pictures, measurements, driving to the property. I think that's only half the battle for, I'm not going to speak for the appraisers, but we don't have them for a couple of weeks. Okay, now what happens and where lenders screw that up and what can put some pressure on your contingencies is because we know that and because I don't want any pressure, we order them the second a contract's ratified. I know that the appraiser is going to take a while potentially to get to the property. And I know that in a worst case scenario, if you guys have to bail on a home inspection in a couple days and your buyer's upset, we'll eat the appraisal. I'd rather do that than wait until a home inspection's clear or wait till the buyer who's dilly-dallying around, doesn't know any urgency with the contract, tells me it's okay. We just order them. I tell them we're ordering, I tell them why, we order them, and if we have to cancel them, a lot of times we can cancel it before they even go to the property. So there's really no risk, and we're gonna make it a no risk for the buyer, because we don't wanna wait around. You guys a lot of times have 21-day finance contingencies on these things, or appraisal contingencies, and I've seen them take 21 days, no problem, to come back to us. So any days we lose where it sits there, now here's what happens. They go to the big bank, they go to the credit union, they go to the loan officer who's not paying attention. The thing sits there, it doesn't get ordered for 3, 4, 5 days. Now tack 3 or 4 or 5 days onto that 2 weeks. Now you're a few weeks out before you even have the appraisal. By the way, the underwriter, once they get it, is supposed to review it, approve it, issue what's called a notice of value. So the appraisal process, it's no different from a valuation standpoint, and it's not a big deal in my opinion on a condition standpoint, but from a timing and management standpoint, it's got to be handled.
So should we rate 14 days?
No, I would do
10?
No, I would do 21.
No, you would.
Yeah, are you messing with me?
Just seeing how far we can push it. So, and what about FHA sticks for several months? How about a VA loan?
No.
Wait a second, there is no time limit on an appraisal for government loans,
On
on the contract.
Oh, we don't get to rate the amount of days
No.
in?
but everyone writes them.
No, there's no place to write it.
Oh.
Oh, there's no place to write
Yeah,
it?
not in the VA, I don't think.
It's
there's
up to
a
the,
VA.
it's up to the VA or
People
FHA.
stick addendums in there or something?
No, I think.
Well, anyway, I don't,
And-
we get them back as fast as we can, so I don't want the heat, so.
Yeah.
And I think on the, you can't issue a commitment letter on FHA until the appraisal's done.
Actually, that's separate. It is a separate contingency on that. We were working that out last week. We can talk about that offline now, but
what is it, something we write? It's not like a.
Yeah, hang on.
It's
So I
not-
We'll
found
get-
it to
we'll
be
get-
a
let's
little
let them run
stricter
through
about
that.
safety issues than a regular appraisal.
They're stricter, they're stricter,
Mhm.
for sure. They're supposed to be.
So how much do those appraisals run?
450, it's the same thing. Okay. Like Paul said, we talked about it briefly, you are gonna have some more safety stuff come up. I don't think it's nearly what it was 15, 20 years ago. Okay? But they will notate some things. Broken windows, broken door locks, any kind of mold. I see a lot is in the older houses, the peeling paint on the outside, they have to bring it up. That includes on a shed or something like that.
Mm.
We always have to have it scraped and repainted. Okay?
Railings.
Whether it's this spot, railings is a good one, whether it's this big or, the whole side of the house.
Yeah,
It's
that's
gotta
where
be done, so just know it going in and set expectations with the seller.
that- Yeah, what about like a barn and all that? That's the same type of
Yeah,
stuff.
I see it on old sheds all the time, there's little
Yeah.
sheds people have in the backyard that are falling down, that are conveying or whatever.
Jesus.
A lot of times if they didn't take care of the house, they're definitely not taking care of the shed. So, and if those are painted with, the appraiser can't say, well, that was painted in '82 paint. They just have to assume it could be lead-based. And it's gotta be scraped and repainted. So that comes up a lot. Okay? I really don't see it screwing up deals, ever. I'm sure it will, but it's, if you get out of that contract and sell it to somebody else, you're very likely to have the same issue anyway. So I think what happens a lot of times is people are just out there scraping them off, repainting really quickly, and it gets fixed.
And I'm sorry.
Yes,
And
Paul.
you did say that they don't stick like an FHA.
Good question. No, they don't, but they can be used by any veteran. It's interesting, when we get the appraisal, it doesn't say Paul on there, it usually says the borrower's name. It actually says any qualified veteran. So like if you had a contract fall out, but you already had it appraised, and you had another one coming in, that was a veteran, you could use that appraisal. Save them some money, not have the value issue come up, that.
Unless it's a bad appraisal, and you don't.
And
Do
you
they know?
You could get a new one.
Will they
No,
know?
No, with FHA you would, with VA you don't.
Yeah,
So you could use it to your advantage if you wanted.
okay, yeah.
And believe it or not, it can happen. We do so many, picture Springfield. We do so many VAs coming in and out.
Oh, yeah.
So it's just a constant.
How many days is it good for somebody else to use?
I would say, I kind of need to get that